Broadcast is now starting. All attendees are in listen-only mode.
Hi everybody, welcome to this revision webinar for A2 Micro. I hope your revision's been going really well during the Easter holidays. In this session, what I'm just going to try and do is to take you through some of the key business objectives, the sort of objectives and aims and strategies that you're going to come across in your A2 Micro papers. And hopefully along the way give you lots of really good, interesting examples to kind of help your revision. Now, this webinar is going to be downloaded as a podcast on YouTube, and you'll also be able to get hold of all of the slides and things straight afterwards. So if you're taking notes, don't forget you'll be able to go through again at your leisure. Now, when you think about business objectives, there are many, many of them. I've put on this graphic, I've put profit right at the top. And for most students, it's their kind of go-to objective. It's the one that they're taught, that firms are profit maximizers, that businesses are looking to get the highest return on capital, that kind of thing. Well, that's okay, that has some validity. But actually in this revision webinar, I'm going to argue that most businesses are profit seeking, but then by no means profit maximizing. Take a look on this slide and you'll see a whole range of other objectives. You're not expected in the exam to cover all of them, but you need to be familiar with a range of alternative indicators, alternative objectives: cash flow, survival, social, ethical aims, market dominance, just the pure growth of a business, etc. The key takeaway point from this slide is that businesses have different objectives. They're not just profit maximizing machines. But we're going to start with profit because it's important. It's important to understand the dynamics of profit and some of the key diagrams you're going to have to draw in your paper. I want to emphasize this point that profit is a key objective of businesses, but it's not always the most important objective. Why is profit important? Here are some points. I'm not going to take you through all of them, but I want to just pick out two or three. I mean, fundamentally, profit is a way of financing investment, be it investment in physical capital, in new technology, profit to fund research and development, or just generating the financial resources to fund acquisitions. And we know as we speak in April 2015 that we're in the middle of a wave of big mergers and acquisitions at the moment. That's partly because interest rates are low, but also because a lot of companies have a huge amount of cash. They're highly profitable, and they're looking for ways to spend the money. So profit's important in terms of as a kind of lubricant to drive investment, to drive research. Profit is also significant as it sends a signal. It sends a signal to existing firms, and crucially, it sends a signal to firms outside the market who might want to come in. I hope you've been revising market structures, perfect competition, monopoly, oligopoly, and contestable markets, because clearly the rate of return in the market is a key factor affecting kind of long-run exit and entry decisions. So, I mean, there were 4 points about profit. I'm focused on the first 2. It's a source of funding for investment. It also sends an important signal in the market. Here's an example, and this is an industry often used by exam boards, the pharmaceutical sector. I mean, Pfizer stands out as the most profitable drugs company on planet Earth, achieving a kind of rate of return of 43% in 2013. That's almost double the rates of return from some pretty big, significant global pharmaceutical companies. Look at the rate of return that Pfizer is achieving compared, for example, with AstraZeneca, one of Britain's biggest pharmaceutical companies. But here's an industry on this slide which is where the big players, and these are all big drugs companies, they're making significant profits. Certainly they're making supernormal returns. How is that money used? Well, on this slide we look at the research and development spending compared to sales. Pfizer, we know, is one of the most profitable companies in the world. A lot of these companies, Novartis, Sanofi, Aventis in France, a significant percentage of the revenue they have goes on research and development. So profit provides the financial resources for companies who need to clearly invest huge amounts in R&D and they get new products to market. And profits are important for acquisitions, or they don't necessarily have to make a profit. I just wanted to show you this slide, which came up a few weeks ago on my timeline. Amazon, of course, has been growing dramatically, very quickly, and it's been using some of its capital to make some pretty significant investments. Zappos was now 5 years ago. It spent nearly $1 billion buying Twitch. Of course, it spent $300 million just 3 or 4 years ago buying Love Film. So companies can grow quickly. Highly profitable businesses have more resources available to fund the acquisitions if they want to. Now we're going to go through a little technical bit, a little bit of theory. The idea is just to take you through the key diagrams so you're familiar and confident with the kind of diagrams you're going to have to be drawing in your A2 micro paper. We're going to focus first of all on profit maximization. And this is particularly for Edexcel students out there. We're going to look at the idea of marginal profit. Now, marginal profit is the idea of one more unit produced and sold in the market bringing a positive marginal return. So this should be a fairly familiar two-dimensional diagram for you. Price and cost on the y-axis, output on the x. For a business, the marginal profit will be positive whenever the marginal revenue, shown here in the red line, is greater than the marginal cost of production. So here the marginal profit is positive, and the company is adding to total profits by producing beyond that point. In contrast, if the marginal cost of production is higher than the marginal revenue, as we see on the right-hand side here, well, then the marginal profit becomes negative. If they produce that particular output level, their total profits will be falling. That doesn't mean they're making a loss, but it means they've moved beyond the profit maximizing output. And this idea of marginal profit just gives us the opportunity to think about profit maximization. Clearly, you're going to maximize your profits when the marginal revenue from selling an extra unit is just equal to the marginal cost of supplying it. And that's shown in the middle there. Now keep in mind these diagrams, they're important. Make them large, make them clear, make them really clean. It sends a very important message to examiners. But this is just a kind of one product idea that the firm can find a profit maximizing level of output. Now let's take this to the next level. So we show profit maximization by bringing revenue and cost together. And I've drawn my demand curve here as fairly elastic, the marginal revenue curve which lies below. So here's profit maximization, marginal revenue equals marginal cost. And we find an output Q1. Once you find the output, you take it up to the demand curve to show the price the firm is able to sell the products at, P1. I'm assuming the firm only charges the same price. Of course, it could discriminate and charge different prices as you find the monopoly. Here's the profit maximizing price, P1. Once you found the price, you find the cost per unit, C1. And if you know that the price per unit is greater than the cost, then this firm can make a profit. And that's going to be our return there. Supernormal profit, because we build normal profit into the average cost curve. So there's a fairly simple, straightforward, hopefully for you guys familiar diagram showing profit maximization. Marginal cost meets marginal revenue. This firm, even though the demand is fairly elastic, even though consumers are price sensitive, they can charge a price P1 well above the unit cost of supply, and they can make a good profit. That's profit maximization. In contrast, some firms, of course, will be loss makers. Maybe their costs are higher than they would like, or maybe they've been in a recession, downturn in the market, which has caused the demand curve to shift to the left. And this is illustrated in this next diagram. Our profit maximisation point stays the same, still where MR meets MC. But if we take up, and you can charge price P1 there, but if we take it up to the cost curve, we see that at Q1, your price you can charge is P1, but your unit cost, average cost, is C1. So you're charging a positive price, but the cost is higher. Of course, the result is you're making an economic loss. Now, for some firms, loss minimization in a recession is an objective, is a different strategy. But actually, loss minimization is also achieved at the point of profit maximization. It's just the result of where the cost and revenue curves are. So we're going to move into the next section. This is looking at the different alternative objectives of firms. Standard theory tends to assume that firms are profit maximizers. And I kind of put that top left, highlighted in red, that's your standard neoclassical assumption. Of course, the reality is very different. I'm sure you'll have studied this as part of your A2 micro course. Most firms have a range of objectives. Most businesses have a multitude of aims and goals. Profit maximization is rarely the single objective of a business. Across the top, above the blue dotted line, I've put the three standard objectives: maximizing profit, maximizing revenue, and growing the business, maybe growing the business to maximize your market share. Typically at A2, those would be the three key objectives that examiners would be looking for you to be aware of. And for each of them, there is a separate diagram you can use to show it. And I'll take you through those in a second or two. Below the dotted blue line, I've just put three additional kind of strands or themes. Bottom left is business survival. We've been through a recession. Markets change rapidly, often dramatically. We live in a world of fast pace of technological change. Nothing is certain anymore. And we see the rise of very disruptive businesses like Alibaba, like Uber, like Facebook. Oftentimes surviving as a business is a key objective. Business survival is a very different, if you pardon the pun here, very different fish from profit maximization. Middle graphic on the bottom there, the rise of social enterprises. This is something that's rarely taught, but there are thousands and thousands of businesses whose main aim is not really the shareholder return. They are companies, businesses with a social dimension, environmental aims, a community focus. They're commercial businesses. They're looking to make money, but they're looking to reinvest the profit they make in a sort of desired way. You could call them not-for-profit. You could actually just tweak it slightly and call them not just for profit businesses. But just be aware of the rise of social enterprises. They're really quite important. I'll give you an example in a few slides' time. And finally, keep in mind that despite privatization, most recently the Royal Mail, we still have several significant state-owned businesses. And again, the objectives that those nationalized businesses have are often different from the sort of fairly narrow commercial stock market driven objectives of private sector businesses. I hope this slide gives you a feel and a flavor for the fact that companies have different objectives. And just to be aware of that, and then use your analysis to show it and to be able to evaluate and apply as you go. Let's take a few examples. I'm going to take examples of industries that typically are used and chosen by exam boards. They like to give you industries and sectors where things are happening, things are changing. There's some kind of theory of the firm you've got to apply here. Here's our first example. I could ask you which handset you're using at the moment, your mobile phone. Probably 5-10 years ago, the majority of my students were using Blackberries, made by Research in Motion. The BlackBerry was the kind of must-have accessory for the ambitious student and business person. Just look at their market share in the UK now. It's below 4%, been overtaken by Sony, HTC. I mean, RAM, Research in Motion, is basically barely exists in terms of mainstream mass consumer handsets. Samsung ahead of Apple. Tremendous growth of Samsung, the Galaxy S6. Samsung spends 1/3 more marketing per device than Apple does. It's a giant kind of battle between those two companies, with Nokia a little way behind. So, think about the context here, everybody. This is a market where firms are battling for market share, battling for sales, they're battling for revenue. They're clearly profit-seeking. They're clearly profit-driven. But I don't think you could say that they're profit maximizers, because the market rarely allows them to do it. Just recently, Samsung announced another significant fall in sales, and effectively they're going to move away from manufacturing handsets towards being a sort of software producer, I guess. You'll be familiar with the grocery sector in the UK. Just last week, it was announced that the sales of Aldi, the German discount retailer, had overtaken Waitrose. Now, this chart is just a month out of date in that respect, but notice here there's continuous day in, day out battle for market share. Crucially, the rise of the discounters, who are really attacking the market. Another industry often used by exam boards is the kind of oligopolistic, almost duopolistic market for carbonated soft drinks. The continuous battle between Coca-Cola and Pepsi. Dr. Pepper's in there as well. Lots of smaller brands, but they barely figure when it looks at the bigger picture. And then let's take the global market. Okay, so this is the data we have, about a year old, for the total market share for biggest car makers in the world. I've put SAIC in there. It's a Chinese company. It is rising up the lists, overtaken Chrysler, Honda, Daimler, BMW. It's on the brink of taking over from Ford. The rise of the big volume car makers based in China, manufacturing for Chinese markets and also exporting. These are markets where the earth is moving, the center of gravity is changing. Are car makers profit maximizers, or are they more in survival mode? Ask the people at General Motors that question. So if firms aren't profit maximizing, what are they doing? Well, one alternative is revenue maximization. And here's our diagram to show it. The yellow intersection is what we saw before, that's profit maximization. Maximize profits where MR meets MC. You maximize revenue where marginal revenue equals 0. And the key revision point here is that gives you a different price and a different output compared to profit maximization. Be really clear in your diagrams. Show the different objectives there. And revenue matters. A lot of my students think that Apple is one of the biggest companies in the world. It's certainly one of the most profitable. It's certainly one of the most high profile. But in terms of revenue, it's barely registers in the top 10. These are the top companies in the world by revenue in 2014. And typically they're the oil companies and the mega retailers such as Walmart. Sales maximization is our third alternative objective. Now you maximize sales when you price at average cost. And again, this is shown on this diagram. It's a bigger output, it's a lower price. We've included normal profit in the average cost curve. So a company, if it just wants to grow, achieve the fastest growth it can, rapid penetration into new markets, build its market share, it will tend to price closer to the minimum profit needed to stay in the market. Sales maximization traditionally is where price equals average cost. That gives this output on this slide here, and it's a much higher output. You see the red intersection there, the red circle, compared with the profit maximizing output, the yellow circle to the left. sales maximisation. And all kinds of businesses that, in my opinion, are driven by the need to grow. The point I'm making here is that a lot of companies, a lot of businesses, they're looking to grow quickly, often linked to managers wanting their companies, their businesses to expand rapidly. Amazon, I think, is one of the best examples of a very fast growing company, growing its sales, growing its customer accounts, growing its revenue, not yet growing its profits particularly significantly. It's been making some big losses recently. But Amazon's strategy is growth, market dominance, vertical integration, and the long run profits they hope will flow from that. Users are not always customers. I think Spotify is a good example. Phenomenal growth of users, but getting people to pay is much harder. It's a useful stat to know that only 1 person in 4 that's downloaded Spotify actually pays a subscription. Again, another industry here, the retail market for coffee. Growth can be seen in terms of users, sales. In this example, we look at growth in terms of outlets. And Costa is far and away Britain's biggest coffee retailer in terms of outlets. Twice the size of Starbucks, and 3 times Cafe Nero. Costa has become a kind of big player in the market, but again, is it a profit maximizer? It's making good returns. It's making significant returns on capital for its parent business, but is it a maximizer? No, it's a profit seeker. It's a market grower, but I don't think you can say it's a profit maximizer. Another interesting issue is when you're trying to break into a market. If you want to make significant inroads into a market, you might have to accept lower profits in the short term to establish yourself. I think a really interesting market for you guys to think about in the revision process is whether Apple's new watch will successfully break into a market which at the moment, as you can see from this slide, is dominated by Samsung and some other players, including the one I own. I've got a Garmin watch, and there's polar watches, which typically are for athletes and things. Here's a market which is clearly growing, existing players in there. How do you break into the market? Do you charge a profit maximizing price, or do you charge a price or a range of prices for your products which should get you established into what you think is going to be a phenomenally successful market in the long term? And again, here's another industry which is, I think, hopefully of interest to you, the market for kind of video on demand, subscription TV programs, dominated by HBO and by Netflix in the United States. It's really a battle for revenue, subscriber numbers. If you win that battle, the profits will flow. It gives you the market power. But a lot of these companies are prepared to sacrifice short-term profits for long-term growth. Just want to say a couple of things to round off about something called satisficing. I think this concept is absolutely key to understanding business objectives and business behavior. Have you come across this word before? Satisficing. Satisficing is a combination of sufficient and satisfactory. And it basically means when firms move away from maximum profit and they find a price and an output, oftentimes using rules of thumb or just market experience, they find a price and output which gives them enough profit to justify their investments, just enough profit to satisfy their shareholders, enough profit not to attract new entrants, but not the maximum profit. So have a look at this diagram. Q2 is a price and an output, which is slightly different to the profit maximizing output, P1, Q1. It can still make a good profit at price P2, shown by the orange shaded area. But it's not the maximum profit, but they're making a decent profit. And crucially, they've got a higher output, presumably a bigger market share, depending on how you draw your cost curves, maybe a lower cost as well. Satisficing is really important. My argument is that most firms, most businesses are satisficers, not maximisers. Finally, a word on social enterprises. I wouldn't expect many students to be fully aware of this, but I think it's really good if you are. There are many, many thousands of businesses these days which are run by social entrepreneurs, commercial businesses of charities, third sector organisations such as housing associations. Social enterprises have a different agenda, different objectives. You could argue that they have a different mindset from your stock market driven, private equity funded businesses. Here's an example from The Guardian a few weeks ago of a food chain business, Social Bite. We've heard a lot recently about food banks, about affordability of food, about food and fuel poverty. Well, here's an example of a social enterprise, Social Bite, which in certain localities in the UK is trying to take on the likes of Greggs and Pret Manger and Subway and McDonald's. Okay, their pricing, their objectives, their strategies will be very different from those commercial private sector businesses. So I strongly advise you to just be aware of social enterprises as part of your revision, and maybe find a couple more examples in addition to Social Bite to add into your revision notes. So just bringing this to a close now, a few takeaway points on the revision session. I would argue that most businesses in complex, fast-changing markets are profit-seeking, but not profit maximizers. My argument is that satisficing has become the kind of default choice for many, many firms. Businesses price and set their objectives as market conditions change. And in the world of rapid technological confusion, those market conditions will alter very rapidly. Your strategies, your aims depend not just on what you are trying to achieve, but what your rivals, both actual and potential, are hoping to achieve as well. Think particularly about contestable market theory, and think about objectives in an oligopoly where businesses are very highly interdependent. And it's not just about profit. The election campaign is telling us a little bit about that as well. Increasingly, businesses have an ethical dimension, a social dimension, a wider concept of value than the pure profit and loss account. Well, that was a revision seminar on business objectives. Hope you found it useful. If you want to continue the conversation, please follow me on Twitter. I'll be happy to answer any questions. And this webinar will be downloaded and the PDF will be available on the links we'll provide. Thank you very much.